Hello traders, welcome back to course 10. We've discussed already risk management, and now we're going to consider the number one cause of death of forex traders. And under this topic, we are going to have the subtopics which is ignoring leverage, right? Most new forex traders fail. Leverage and margin explained, margin call explained. Be careful trading on margin. See how leverage can quickly wipe out your account. Low leverage allows new forex traders to survive. Low leverage affects transaction costs. Never underestimate leverage. Okay, so these are the subtopics under 10.2, the number one cause of death of forex traders. So begin. Let's roll the intro. So welcome, here we are on ignoring leverage, why most new forex traders fail. So let's see what the professionals do. Most professionals, like money managers and others, they trade one standard lot for every account in their for every $50,000 in their account. Did you get that? Professional forex traders and money managers, they trade one standard lot for every $50,000 in their account. So if their account is $50,000, they only trade one standard lot. And what is a standard lot? A standard lot is one. Okay, and one in this regard is, it means that if the market tick by one move, okay, or two, it is going to be a $10, okay, either in profits or loss. $10, whereas the account is 50,000 US dollars. So they only trade one standard lot. Now if they traded a mini account, this means they traded one mini lot for every 5,000 in their account. So let us sink in your hair for a couple of seconds. Okay, so if professionals trade like this, why do less experienced forex traders think that they can succeed by trading 100,000 standard lots with a 2,000 account, or 10,000 mini lots with a 250 US dollar account? No matter what forex brokers tell you, don't even open a standard account, okay, with just 2,000 US dollar, or a mini account with $250. It's going to wipe out. So even though they allow you to open these accounts, they disappear. Your money goes in less than a second, or a few seconds, or minutes, or days. So the number one reason why new forex traders fail is that they do not know the difference between the leverage and capital in their account. Okay, so they fail not because they are really bad or they suck at trading. It's because they are undercapitalized from the start and don't understand how leverage really works. So here I am, leverage. Now die. Leverage kills. It burns your account. So don't set yourself up to fail. So what is recommended? Now it's recommended you have at least 100,000 US dollar of trading capital before opening a standard account, or a 10,000 US dollar for a mini account, or a 1,000 US dollar for a micro account. Oh my goodness. So do you know what a micro lot is? A micro lot is start from 0.01. That's a micro lot. So if you have 1,000 US dollar in your account, okay, 1K, the lot size you should take, a micro lot, is 0.01, and 0.01 is in cents. It runs in cents, not in dollars. So if you make profit, if it ticks up in your favor by 1, 2, okay, you make 3, 1 cent, 2 cents, 3 cents. Okay, so if for instance you lose 30 losing streak, okay, you're still gonna make money. I mean, you still have a lot of money in your account. You don't even lose up to $50 out of your 1,000 US dollar. And so what does that give you? it makes you stay in the game, in the business for the long time. You see, think like the rich statisticians, those who own casinos. That's how they make money, because they stay in the game for the longer period of time. Okay, so if you only have 60,000 US dollar, open a mini account. If you only have 8,000 US dollar, open a micro account. If you only have 250 US dollar, open a demo account and stick with it until you come up with the additional $750. Then open a micro account. If you then open a micro account and put 1,000 US dollar in your micro account. Now, if you have $50, if you have $20, if you have $100, go and find a job. Don't come to the forex market. Okay, find a job. Oh my goodness, I love this. Okay, now so reread the previous paragraphs and ingrain it in your head. Okay, just because brokers allow you to open an account with only 25 does not mean you should. Okay, listen, the people who Babypips, they are professional traders. They've been in this business for a long time, and they are putting out this valuable content for free. So if they are giving all this nugget and all this knowledge for free, plus they have hundreds of traders in their platform, and and they are dishing out these things free, they know what they're talking about. Okay, so please listen, and listen good. Now, we believe most new traders who open forex trading account with the bare minimum deposit do so because they don't completely understand what the term leverage and margin really are and how it affects their trading. It is crucial you are fully aware and free of ignorance of the significance of trading with leverage. So if you don't have rock solid understanding of leverage and margin, we guarantee that you will blow your trading account. Like, it's a guarantee. It is going to be like zoom. Oh my god, my account is gone. Yes. So you should have opened the demo account. Now let's move to the next lesson that says leverage and margin explained. So what is leverage and margin explained? Now, what is leverage? Now, according to definition of a textbook, leverage is having the ability to control a large amount of money using none or very little of your own money and borrowing the rest. For example, to control a 100,000 position, your broker will set aside 1,000 from your account. Your leverage, which is expressed in ratios, is now 100 to ratio 1, which means the position you want to control is 100,000, but you have to bring 1% of it, like drop something. So 100 to ratio 1. If you put $1,000 in your account, which is 1, you can control 100,000. So know this. Go back and look at your leverage with your broker. What leverage do you have? What leverage do you have? It's very important. Go back to your broker right now and look at it. Okay, now you are controlling 100,000 US dollar with just 1,000. Okay, so now let's say they want 100,000 US dollar investment rises in value to 101,000 or 1,000. So if you had to come up with the entire sum of 100,000 US dollar in capital yourself, you would just return a puny 1% of it, which is 1,000 gain. Okay, on that 100,000 US dollar initial investment. I don't know if you understand it, but I do understand. If you don't, read it again. If you had to come up with the entire 100,000 capital yourself, your return would be just 1%. That is 1,000 gained divided by 100,000 initial investment, and that is called 1 to ratio 1 leverage. Now, 1 to ratio 1 leverage is a misnomer, because if you have to come up with the entire amount you are trying to control, where is the leverage in that? There's no leverage. Okay, you're not leveraged at all as 1 to ratio 1. So but you are leveraged at 100 to ratio 1. Now the broker only had to put aside 1,000 of your money, so your return is groovy 100%. That is 1,000 gain divided by your 1,000 initial investment. Okay, now let's do a quick exercise here. Okay, let's calculate what your return would be if you are using 100,000, if you are controlling 100,000, 100,000 US dollar financial worth of investment or financial instrument. If you are controlling 100,000 position, but you only invested 1,000, so with your 1,000 you are controlling 100,000 investments. Now what would be your profit if you lost 1,000? Okay, how much will you get in profits? It's a stupid question, but it's meaningful. How much will you get? You are controlling 100,000 US dollar position with your 1,000 US dollar, and now you lost 1,000 US dollar. How much will you make? Simple, zero. You're not going to make any money, okay, on that leverage of 100 to ratio 1. So you've probably heard the old cliches like leverage is a double-edged sword or leverage is a two-way street. So as you can see, the cliches weren't lying. Now what is margin? I know you and I will have discussed about this before, we have learned it before, but let's go back so we can really get this drained deep down in our head. In Forex, to control a 100,000 position, your broker will set aside 1,000 from your account, which is your leverage, and this expressed in ratios. So it is now 100,000 position in ratio to your 1,000 US dollar, which is 100 to ratio 1. So you are now controlling 100,000 with your 1,000 US dollar. So go back to your trading account and look at your leverage. Again, I'm saying it, look at it. If you are using a leverage of 100 to ratio 1, it means you ought to have 100,000 in your account, but you don't have it. And some of you also, you don't even have up to, what is it called? Let me write this here. It's funny. You don't even have up to 500 US dollar, okay? 500. Whereas you are using 100 to ratio 1. Some have just 25 US dollar and they're going to pick 100 to ratio 1 leverage. It's stupid. Why won't the account get blown? And then on top of that, some might want to be taking 0.05. Crazy. On a $100 account, or on a $50 account, or a $25 account. It's crazy. That's why they don't stay, or they don't last longer or long enough in the Forex market. You're killing yourself. That's gambling. Now, what is margin? The 1,000 US dollar deposit is your margin. You have to give this in order to use leverage. Now, margin is the amount of money needed as a good faith of deposit to open a position with your broker. Now, margin is usually expressed as a percentage of the full amount of the position. So for example, most Forex brokers will say they require 2%, 1%, 5.5%, or 0.25% margin of the position you want to control. So your broker calculates this in percentages. Now, don't think with this you're going to be, let me just drink all of this down, let me just crunch all this down, it's going to be interesting because I have leverage. No. If your broker requires 2% margin, you have a leverage of 50 to ratio 1. This is what it means. Margin requirements, leverage, maximum leverage. So they put all this down in percentages, and it's honestly speaking, it is really confusing. there's much confusion about different margins. So let's try and break it down in our own terms. What is margin requirements? This is an easy one because we just talked about it. It's the amount of money your broker requires you to open your account, to open a position. Okay, so it is expressed in percentages. Margin requirement is expressed in percentages. Now, what about account balance? It's the same thing. It's just another phrase of your trading bankroll. The amount of money that you must have or you put in your trading position or your trading account. Now, what is used margin? Used margin is the amount of money that your broker has locked up to keep your current positions open. Okay, why this money is still yours, you can't touch it until your broker gives it back to you. Either until your broker gives it back to you, or until you manually close your current positions, or when a position is automatically closed by your broker. Now, usable margin. This is the money in your account that is available to open a new position. Now, usable margin, this is the money in your account that is available to open new positions. Now, margin call. You get this when the amount of money in your account cannot cover your possible loss. It happens when your equity falls below your used margin. So if a margin call occurs, your broker will ask you to deposit more money in your account. If you don't, some or all of your open positions will be closed by the broker at the market price. Now, get this, okay? It's about this margin call. No broker will call you. I've burnt accounts several times. I wasn't given a call. But the only thing you can see, you can get if you are on, right? If you are live, if you are monitoring the trades and you're just watching it, you will get to see that your trading bar, right, where you see your equity, your account and all that, it will all be blinking red. It will just be blinking there like that, like a red sign doing just bam. And if you don't close your account or anything, your broker will let your positions run in loss until it gets to zero. Nobody's gonna give you a call. Your positions will not be closed out unless you do close it out, or unless you have a stop loss. But if you don't have a stop loss, your account is going to go down to zero. Like, believe me, I've watched that happen. It's going to go down to zero. No, this color ain't good enough. Let me choose a very good color just so you can understand what I'm talking about. It will go down to zero, like zero, like negative. The brokers will let your account go negative 5k, 5,000. They will let your account go negative 10,000 US dollar, 50. Okay, so make sure you're having a stop loss, or make sure you have a very good leverage. Now remember what we just learned here. So if you haven't yet subscribed, smash the like button and subscribe this video. Okay, and let's go to the next lesson that says margin call explained. So margin call explained. So assuming you are a successfully retired British spy who now spend his time trading currencies, you open a mini account and deposit 10,000 US dollar. Now when you first log in, you will see the 10,000 in the equity column of your account information below. Okay, now usable margin. Usable margin, you will see the margin that also includes a used margin. Okay, and it is going to be 0.0, and that is be the usable margin. Is what did I just say? Usable margin. You will see that the used margin is 0, and that the usable margin is 10,000 as pictured below. Why? So used margin, you have not taken any trades. No amount is deducted from your account. Usable margin is the amount you have put into your funded your account with, and it is going to be 10,000 usable because you've not touched it. Your account balance will also be 10,000. That is everything, and your equity will be also 10,000. Now your equity is a summation of your account balance, used margin, usable margin. That's what makes up your equity. Okay, now this, as we are seeing here on Babypips, might be different from your forex broker, what is going to get in your forex broker from your forex broker or your MetaTrader 4. Your MetaTrader 4, you might just see use margin, you might just see equity, you might see balance, okay, or you might see usable margin as well. Okay, so usable margin is equal to equity minus used margin. We just explained that. So all this is calculated by you, calculated for you automatically by your broker. Now, as long as your equity is greater than your used margin, you will not have a margin call. Now, margin call occurs when you have gone below your drawdown and your account is going to be about getting wiped out. You will get a margin call. But like I have maintained earlier on and I have always said, your broker never gives you a margin call. They don't care. So you have to care about your account by using stop losses, leverage for your leverage to your favor, and also watching your trades. Okay, so as soon as your equity falls or falls below your margin, below your used margin, you receive a margin call. Remember, you will not be called and you will wake up to your account getting burnt. I'm saying that again and again. Now your equity remains 10,000. Used margin is now $100. Let's say you take a trade, okay, because the margin required in a mini lot or mini account is $100 per lot. The usual margin is now 9,900 naira. So 9,900 US dollar. Why am I saying 900 naira? Because I'm from Nigeria, right? Anyway, so yeah, let's do this together. It doesn't matter where you're from. You can trade forex market from any place you are. Now, if you were to close out that one lot of Euro USD by selling it back the same price at the same price, okay, which you bought it, your used margin will go to your zero. Your usable margin will be back to 10,000. Your equity would remain unchanged at 10,000. Now, but instead of closing the one lot, let's say you are the adrenaline junkie, you know, you shop socket person that you are, you got extremely confident and you bought 79 more lots of Euro USD, which is a total of 80 lots at $100 per lot. That would mean 8,000. That would mean 8,000 if you had 80 lots at $100 per margin per lot. That will mean 8,000, and what will happen is that your usable margin will now go to 2,000. Your used margin, which you have used, okay, because you bought 80 lots, will be 8,000. Your equity will still be at 10,000. Your balance will still be at 10,000, because this is the total. Equity is your total of everything that is inside. Balance is what is left off. Okay, it will still stay like this until the result of this trade comes out. Now, what do we have here? So, do we need to explain all this? Okay, let's just go. Let's do that quickly. So, this is extremely risky. So, now let's paint a horrible picture. Now, your used margin will still remain at 8,000. Now, once your equity drops below 8,000, okay, your equity, once it drops below 8,000, you will have a margin call. This means that some of your trade position will also, some of your positions that are open will automatically be closed at the current market price. Now, assuming you bought 80 lots at the same price, a margin call will trigger. A margin call will trigger if your trade moves 25 pips against you. Okay, if you just move 25 pips against you, a margin call will be triggered. Now, how do they come up with 25 pips? Well, each pip in a mini lot is $1, and you have a position open consisting of 80 lots. Now, $1 per pip times 80 lots, that is $80 per pip. Now, if Euro USD goes up 1 pip, your equity increases by $80. Now, if USD goes down by 1 pip, your equity decreases by $80. Now, 2,000 usable margin divided by $80 per pip, that is 25 pips. Okay, so let's say you bought 80 lots of Euro USD at 1,200. Okay, this is how your account balance will look like. If it drops to 1.1975 or minus 25 pips, your account balance will go like this. Your equity will be 8,000. Your used margin will be 8,000. Your usable margin will be 0. Your balance will be 10,000 naira. 10,000 US dollars. Excuse me for saying naira. Now, it is if you okay. Now, The reason margin now becomes turns zero, okay, you receive a margin call. Now, of course, you aspire, you're doing what you're doing, you've got eyes on your veins and all that and all that. It's still time, and you look at your account, it's still like this, and if the market moves against you or less than 0.22%, okay, you're going to lose 2,000 US dollar. Now you just blew 2k of your trading account, okay, and that's really, really sad. Now we didn't even discuss spreads into that, because if you add the spread, spread is the cost of trading any particular currency your trader lets you, I mean your broker lets you take. So let's simplify the example. We didn't even factor spread, okay, like we are learning here now. So let's say the spread of each euro USD is 3 pips. Now this means that euro USD will only have to move 22 pips, not 25 pips, before you get a margin call. Imagine losing 2,000 US dollar in 5 seconds. This is what could happen if you don't understand the mechanics of margin and how to use leverage. Now the sad part is that most traders don't even open a mini account with 10,000 US dollar, because you had at least 10,000, you were at least able to weather 25 pips this margin before a margin call occurs. Now if you only started off with 9,000 US dollar, you'll only be able to weather 10 pips drop, including spread, before receiving a margin call. That is if you take terrible 80 lots, 80 trades, okay, 80 trades at one lot sizes, okay. So that is that with regards to understanding how margin works and how it is explained. So remember, the margin is your power. Use it to your very advantage. You've talked about leverage, we talked about margin right now. Margin is your money, okay. Don't open lots of trades down, because your margin increases. Don't increase your margin. Now let's move to the next lesson. Plus, if you like what we just discussed here, please smash the like button. It doesn't take a lot. Just click on the like button, okay, and click on the subscribe button also if you haven't subscribed yet. So the next lesson says, be careful trading on margin. So here we are on be careful trading on margin. Now we have already established that margin is the amount of money you must put in your account for your broker to be able to let you take a trade, right? So it is called a good faith deposit or collateral needed to open a trading position. Now margin trading gives you the ability to enter into positions larger than your account balance. Now, although buying and selling on margin does not provide leverage in and of itself, it can be used as a form of leverage. This is because how big of a position size you can open typically depends on how much money you have in your account. So let's see this diagram that talks about trading on margin. Now trading currencies on margin lets you increase your buying and selling power. Now this is trading on margin. Here you have your account deposit, right? This is too big. Let me reduce the size. Here you have the small amount of money you have deposited, which is your margin. But now on the other hand, here you have your leverage, which you have chosen, and it is very big, okay. Now this is your buying power. Now your buying power now becomes the margin, okay. Now know this, it is because of your leverage that you have lots of buying power, not because of the margin, okay, that you have the buying power. Your margin, which is your deposit here, look at how small it is, but now look at your buying power here. It is very, very big, almost 5 or 6 times bigger than your deposit. And this is, you're having this buying power because of your leverage, okay. Sink that in, please. You are having the buying power because of your leverage, not because of any other thing else. It's just because of your leverage, okay. So understand that. Now once you have your leverage, you have your deposit, do not abuse your buying power. Do not continue to, don't just take in lots of positions like that guy that veteran who took lots of positions, 80 trades from his 10,000 USD dollar account that he opened a mini account on. Okay, because when these trades, all 80 trades, when they just went down 22 pips alone, okay, his account went down to 2K, and the account is gone. It will be very difficult to make it back. Okay, so don't abuse your buying power. Because you can control lots of buying position doesn't mean you should just keep on buying or increasing your positions all the time. Now, what is margin call? We have said it. Okay, we've established that once you abuse your buying power, you are going to get a margin call. A margin call occurs when your margin falls below what is will be expected from you by your broker to take you into any trade. You get a margin call. Your positions will be closed, and then many times you will not even get a margin call. Okay, so let's say you have 80 trades, okay, and they are all trades going against you. You find that out. Your broker will just close out like 70, maybe 50 positions, maybe 30, and maybe he leave 20 trades running, or maybe he even close 10, or maybe even leave 5 trades, just 5 trades running for you, and so you get margin call. So your time, sometimes you get a call, but most time, majority of the time, you don't get a call. I have never been called for my accounts that have blown and all that. You never get called. And here, keep in mind that you may experience your stop loss may experience massive slippage when the market is moving fast. Okay, and then you should also know that your brokers, they require a higher margin during the weekends. If you are trading during the weekends, they require higher margin, and this may take form of 1% margin during the week, and if you tend to hold the position over the weekend, it may rise to 2% or higher. So brokers also may have different margin requirements for different currency pairs, so pay attention to that as well. And also try and go and read your broker agreement or your terms and conditions from your broker's website and see how all this affects your trades, okay, your trading. Now please, if you just like what we just discussed, smash the like button for me. It doesn't take you a lot, or doesn't take anything from you. Smash the like button, subscribe to this channel if you haven't, and let's move to the next lesson that says see how leverage can quickly wipe out your account. So see how leverage can quickly wipe out your account. Now hopefully you have understand what margin is. Now let's look at leverage, okay? Because many of the unsuspecting traders, they usually think leverage is something that they can enjoy. Eat too much of it, and then be very okay. However, when you have too much of leverage filled in your stomach, you just have to throw it all out. Why? Because there are many forex brokers advertising that they offer 200 to 1 leverage or 400 to 1 leverage. Okay. Now the thing is, you have to be clear that that is a maximum amount of leverage that you can use. Now remember this, leveraging ratio depends on the margin required by the broker. So for example, if a 1% margin is required, you have 100 to 1 leverage. Okay, now there is a maximum leverage and there is also true leverage. So what is true leverage? True leverage is the full value, also known as notional value, of your position divided by the amount of money deposited in your trading account. Do you understand that? Let's use this illustration. You deposit 10,000 in your account. You buy one standard lot of 100,000 of US dollar, Euro USD, at the rate of 1.0000. Okay. Now the full value of your position is 100,000 US dollar, and your account balance is 10,000. So your true leverage will look like this. Your true leverage is 10:1. Okay, because you have 10,000 US dollar in your account. So your true leverage will be, okay, 100,000 divided by 10. Okay, by 10,000. So that will give you 10:1. Okay, because you are using a standard lot. So standard lots account usually start from 100,000 US dollar. So your true leverage is also known as effective leverage. So let's say you buy another standard lot of Euro USD at the same price. Now the full amount of your position is now 200,000 US dollar. Okay, remember it is standard lot, but your account balance is still 10,000 US dollars. So your true leverage is now 20 to ratio 1. Being that you have bought two standard lots, it means you have 200,000 divided by 10,000. So it is going to be 20 to ratio 1. This is your true leverage, effective leverage, or notional leverage. I hope you understand that. Now, you're feeling good that you buy and you went on to buy 3 more standard lots. Standard lots. You also have 100,000 in your account, but you only have 10,000 in your account. Again, at the same rate, the full amount of the position you are now controlling is 500,000 because you bought 5 now altogether. When you bought here, it has 2 standard lots. When you bought 3 more, For instance, we're using this as an example, right? It's now 5. So I start 500,000 standard lots. Whereas the actual money margin you have is $10,000. So your true leverage is now going to be 50 to ratio 1. Why? Because you have opened 5 standard lot positions on your 10,000 US dollar account. So now, assuming the broker requires a 1% margin, now this is what's going to happen. If you do the math, your account balance and equity are both going to be 10,000. Your margin, your used margin is going to be 5,000, and your usable margin is going to be 5,000 for one standard lot, because each pip is $10 per pip. Okay, so in order to receive a margin call, you would have to move 100 pips. That is 5,000 usable margin divided by $50 per pip. Now this would mean that the price of Euro USD will have to move from 1.440 to 9,900, a price change of just 1%. Now, after the margin call, your account balance will be drawn down to 5,000. You lost $5,000 or 50% of your account, and the price only moved 1%. That's crazy. Do you understand what happened? I hope you do, because if you don't, please come back to this and study this again. Now, let's pretend you ordered a coffee at McDonald's drive-thru, then you spilled the coffee on your lap while you were driving, and then proceeded to sue and win against McDonald's because your legs got burnt and you didn't know the coffee was hot. To make a long story short, let's say you deposited 100,000 US dollar in your trading account instead of 10,000 US dollar. Now, you just bought one standard lot of Euro USD at the rate of 1,440, okay, 1,000, 1.1,000. The full amount of your position is 100,000 US dollar, and your account balance is 100,000 US dollar. Your true leverage is 1 to ratio 1 because you actually have 100,000 US dollar in your account. Do you understand? So here's how it's going to look like. 100,000 for account balance, your equity will be 100,000, your used margin will be 1,000 because that is the margin you used, and then your usable margin will be 99,000 because that is what is left. Okay, now in the example above, you receive a margin call. The price would have, in order to receive a margin call with this example above, the price will have to move 9,900 pips. That is 99,000 usable margin divided by $10 per pip. It will have to move 9,900 times. Now this means that the price of Euro USD will have to move from 1.440 to 0.0100. That is a change, 99% change basically, or 100% change. So let's say you bought 19 more standard lots again at the same rate as at the first trade. The full amount of your position is 2 million and your account balance is 100,000. Your true leverage is 20 to ratio 1, and your account look like this. 100,000, equity is 100,000, usable margin is 80,000, and then the use margin is 20,000. Okay, now in order to be given a margin call, in order to be margin called, right, the price will have to move on 400 pips. 400, that is 80,000 usable margin divided by $10 per pip, multiply it by 20 lots. That means the price of Euro USD would have to move from 1.0000 to 0.9600, a price change of 4%. Okay, so if you did get a margin call and your trade exited at the margin call price, this is how your account would look like. $20 account balance, equity $20,000. Okay, used margin 0, usable margin 0. From your 100,000, you have lost 80,000. Okay, that's when you take crazy trades like this. 400 pips against you, $10 per pip, multiply by 20 lot sizes, and it goes 400 pips against you. Your account is going to go like this, from 100,000 from 100,000 US dollar to 20,000 US dollar. You would have wiped out 80% of your account, and the price only moved 4%. And you would probably be looking like this guy here. Yahoo! He's smiling, right? No, he's crying. He just lost all his entire life savings. 100,000 US dollar now turned to 20,000 US dollar. 80,000 US dollar gone. So do you see the effects of trading? Of leverage. Leverage amplifies the movement in the relative prices of a currency pair by the factor of the leverage in your account. Please, if you understand what we just discussed about, or if you do not understand how all what we have been discussing, feel free to check the earlier courses on margin and margin 101 courses. Okay, and then study all of this again. Let's just take a look. Okay, I sign this out. All right, now next lesson is low leverage allows new forex traders to survive. So smash the like button, subscribe if you haven't, and I will see you. So here we are on low leverage allows new forex traders to survive. Now it is important that you understand the difference between leverage and margin. Now that you know that, it is also crucial that you understand both the benefits and the disadvantages of using leverages. So let's say you are using a ratio of 100 to ratio 1. As an example, it means that it's possible for you to control or to get into a trade for up to $100 for every $1 in your account. Now, with as little margin as 1,000 available in your account, you can trade up to 100,000 at 100 to ratio 1 leverage. So this gives you the potential to earn profit on the equivalent of a 100k trade. Now, it doesn't matter if you are very skinny like this guy and your opponent is as big as Arnold Schwarzenegger. Once you know how to use leverage, okay, you can come out victorious against your opponent. When leverage works, it magnifies your gain substantially. Okay, but don't let your head get big and you think that that's the greatest way to become rich. Okay, because leverage can also work against you. It can also amplify your potential losses, and you can become as broke quickly as McCarthy can bite off your ear. Okay, so here's a chart that shows you how your account balance changes if prices move depending on your leverage. So this is the leverage ratio, okay, and this is the changes in this is the percentage change in currency pair, and here is a percentage change in your account. So if you're using a 100 to ratio 1 leverage, the change in percentage, the percentage change in currency pair is 1%, and the percentage change in your account is 100%. Okay, so if you're using a 100 to ratio 1 leverage, just know that profit or loss is going to be 100%. If it is 50 leverage you are using, profit or loss is going to be 50%. If it's 33, it's going to be 33%. It goes the way, okay, profit or loss, either ways. Now, let's say you bought USDJPY and it goes up 1% from 120 to 121.20. Okay, now if you traded one standard lot 100k, let's see how your leverage would affect your return. So let's say you have 100k standard lot trade at a leverage of 100 to ratio 1, Your margin required is, that is the amount of money required to, you need to have in your account balance, is 1,000. The percentage change in the account is plus 100% because you are using 100 to ratio 1 leverage. If you are using 50 ratio leverage, it's 50%. If you are using 33, it's 33%. If you are using 20, that's 20%. Also, your margin is going to be affected the same way as well. So it is like that. Okay. Now, if you're using 1 to ratio 1, your leverage is going to be 1%. Okay, so let's say you bought USDJPY and it goes down by 1% from 120 to 180.80. If you traded one standard 100k lot, here's how leverage would affect your return or loss. So let's say your leverage is 100 to ratio 1, your margin is 1k, your percentage change in your account will be minus 100%. Okay, if it is 50, minus 50%. If it is 33 to ratio 1 leverage, it is 33%. If it is 20 ratio 1 you use, it is going to be minus 20. Okay, this is the margin required, okay, to open these positions. Now, the more leverage you use, the less breathing room you have for the market to move before a margin call. Now, you might say, well, I'm a day trader, I just use 20 to 30 pips stop loss. So let's take a look at using 20 to 30 pips stop loss. So you open a mini account with $500, which takes 10k mini lots and only requires a 0.5% margin. Now you buy 2 mini lots of Euro USD. Your true leverage is 40 to ratio 1 because that's 20k divided by 500, which you have. Now you place a 30 pip stop loss and it gets triggered. Your stop loss is $60. Your loss is $60. That is to say, $1 divided by the pip multiplied by 2 lots. Okay. Sorry, that is $1 per pip multiplied by 2 lots. So if it is 30 pips, okay, multiplied by 2 lot sizes which you used, that will be $60. Your account has now lost 12%. You are now minus 60, and that's 440, okay, of your account balance. Now you're feeling good, you believe your next trade will be great. Your true leverage is now 90 to ratio 1 because that's about 40. The more your account balances drops, okay, have you noticed that the more leverage you have? It's automatic, just so that you'll be able to control, you'll be able to take good take trades within this money. So if the leverage doesn't increase, you will not be able to take trades efficiently like you should have been able to use to trade. So you set your stop loss to 30 pips again. This time you got stopped out at 4 lot sizes. You 30 pips, 3 times 4, that's 12, $120. That's $1 per pip times 4. Now you've lost 27% of your account. Your account balance is now 320 USD. Now you buy 2 mini lots of Euro USD again. Your true leverage is 63 to ratio 1. Now you set your actual pip to 30 pips stop loss and you lose again, lost $60. That is $1 per pip multiplied by 2 lots. So you just you've lost almost 90% of your account, and your account balance is now 260. You're getting frustrated. You think, what is it you're doing wrong? Okay, you think you are setting your stop loss too tight. Okay, you decide to open 3 more mini lots of Euro USD at a true leverage of 115 to ratio 1 at $260 account opening balance. Now this time you're losing your stop loss from 30 to 15. The trade starts to go against you. It looks like you're about to get stopped out. You get stopped out. This time you get a margin call. Now the leverage that you have drank and the margin you have been using, you are now gouging out. Okay, now since you opened 3 lots with 260 account, your used margin was 150. So your usable margin was a measly $110. The trade went against you 37 pips because you had 3 lots opened. You get a margin call. Your position has been liquidated at market price. Okay, if your position is liquidated and you come out with $100, congratulations. Most forex brokers don't even liquidate your positions these days. They let it to run out until your account goes to 0. Okay, now the only money you have left in your account is $150. Okay, the used margin that has returned to you after your margin call. Now, after your 4 trades, your total trading account has gone from 500 to 150 US dollar, a 70% loss. Congratulations. It won't be very long until you lose the rest. So this is how your trading account looks like, or the trading account looks like for somebody who took those trades in the example we just discussed that Babypips came up with. So most experienced traders, okay, they have similar experiences. Like professional traders, the experienced ones, they have similar longer losing streaks. Okay, the only reason they are successful is that they use low leverage. Get that in your mind. They use low leverage. So you are using, or a newbie is using 100 to ratio 1. When he loses a trade, he loses 100% percentage of the account. Get that right. If you are using 100 to ratio 1, if you win the trade, okay, you win 100% of the trade. If you also lose the trade, you lose 100% of the trade of your account. Sorry, of the account, not the trade. 100% of the account. Now, for professional traders, what they do is that they don't use high leverage. They use the lowest leverage, because they understand that if they use the highest leverage, when they lose a trade, they're going to lose more. So they use the lowest leverage, and the lowest leverage requires that you do something, and I'm going to tell you later on, okay? So the reason they are successful is that they use low leverage. Most cap their leverage at 5 to ratio 1, but they rarely go that high, and they stay around 3 to ratio 1. The other reason experienced traders succeed is that their accounts are properly funded. So while learning technical analysis, fundamental analysis, sentiment analysis, building a system, trading psychology are important, we, Babypips, believe the biggest factor on whether you succeed as a forex trader is making sure you capitalize your account sufficiently and trade that capital with smart leverage. That's the secret. So the number one reason why many forex traders fail, or new forex traders fail, is not because they don't know what they are doing, it's because of leverage and undercapitalization. So your chances of becoming successful are greatly reduced below a minimum starting capital. It becomes impossible to mitigate the effects of leverage on too small an account. So low leverage with proper capitalization allows you to realize losses that are very small, which not only lets you sleep at night, but allows you to trade another day. Example 2, I am not going to consider, or we are not going to consider. If you want another example, please come back and read it. As you can see from the example, the leverage that you drank, you think you're enjoying, you gushed out. And at this moment, I am not feeling well. I better deleverage. That means I better go down on a smaller leverage. So go down on a smaller leverage and fund your account very well. Capitalize your account very well. If you like what we just discussed, before we go to the next lesson, smash the like button and subscribe. The next lesson says how leverage affects transaction costs. Now this is going to be very, very fast and super quick, because we just discussed something similar before we got here. Now, there is something that is killing you or killing forex traders, especially new forex traders, but they do not know. They don't even see it coming until they're dead. This killer we are talking about is the associated transaction cost of using high leverage. Not only does leverage amplify your losses, but it also amplifies your transaction cost as a percentage of your account. Please understand this. Not only does leverage amplify your losses, it also amplifies your transaction costs as a percentage of your account. Did you understand that? Leverage also amplifies, it increases your cost of taking a trade as a percentage of your account. So, if you are using high leverage, when you lose a trade, you pay the cost in percentage. It can be 1%, it can be 2%, it can be 3%. The cost of the cost of the leverage that you are using for that particular trade is deducted from your account in percentages, not in figures. Okay, so these transactions are what is killing new and inexperienced forex traders. So let's say you open a mini account with $500. You buy 5 mini 10k lots of GU, which has a 5 pip spread. Okay, now 5 pip spread. Your true leverage is 100:1. 50,000 total mini lots divided by 500 accounts. Now, but check this. You paid $25 in transaction costs. That is to say, $1 per pip times 5 pip per spread. That is 5 lots. That's 5% of your account. Now, in case you are wondering how we got to 5% of your account, is this: you buy 5 mini 10k lots of GU. So you opened 5 positions. Okay, so $1 per pip multiplied by 5 pip per spread, that is times multiplied by 5 lots. Okay, that's $25. $25 of 500. That is 5% of your trading account. So with one trade and the market not even moving yet, you are already down 5%. If your trade lose, your account balance shrinks in 5%. So your account balance shrinks. As your account balance shrinks, your leverage increases automatically. So as your leverage increases, the faster your transaction costs eat away at the little money you have left. This is the slow and silent killer we are talking about. The higher your leverage, the higher your transaction cost as a percentage of your trading capital. This is why transaction costs are one of the 6 most important factors when choosing a broker. So go back and look at the 6 most important factors of choosing a forex broker if you have done that. For example, if you go long on 10,000 units Euro USD with a 5 pip spread, which equals $5 per transaction cost, look at how the value relative to your account, okay, cost. Look at how the relative value of your transaction costs increases with more leverage. So if you are using 200:1 leverage, the margin required will be $50, but costs of transaction, okay, cost as percentage of margin required is 10%. If you are using 100:1, it is 5%. If you are using 50:1, it is 2.5%. If you are using 33:1, it is 1.50%. If you are using 20, it is 1%. If you are using 10, it is 0.50%. Okay, so you see this: the lower the leverage you use, the lower the transaction cost in return. However, once the leverage is low, you have to fund with much money because the broker is no longer funding, helping you out. Okay, so you have to add more money to it. Then, now that you have learned how leverage can magnify your profit and losses, but also your transaction costs, you also need to know that leverage does not equal margin. Leverage is how many times you lever your whole account. The maximum amount that you are allowed to lever is dependent on your margin requirements. So if you like what we just discussed here, if you understand this part, please smash the like button, subscribe if you haven't, and we shall see in the next lesson that says never underestimate leverage. So here we are on never underestimate leverage. Now, most beginners underestimate the potentially devastating damage leverage can wreak on their account. So understanding leverage enough to know when to use it and when not to use it is as critical as successful you will be in the long run. So don't get too greedy. Watch your leverage, son. Now, leverage is both powerful tool to both new traders and to old traders, and they use it to destroy their trading capital simply because they take its destructive flaws too lightly or ignore it altogether. What a pity. The easier it is for us to make smart trades for us and make money is to be able to understand how to use leverage properly. Okay, Now, always keep in mind these words from a famous superhero: with great power comes great responsibility. I'm sure you know the movie and you've seen the movie Spider-Man. Okay. Anyway, high leverage is favorite selling point of most forex brokers today. Okay, but you don't know, right? They tell you high leverage, you can do this with this with this, but the more and the high leverage you use, the more they are charging you for the transaction. Okay, they let you use small money to trade because they borrow you money or they put the money there for you, but the more they charge you for that cost of transaction, and it's that cost of transaction which they benefit from, and that's why they are giving you more leverage. So most brokers want you to trade with a short-term mindset. Be like the smart casino statisticians. They trade with a long-term mindset. They want you to trade as much as possible, as often as possible. It's the only way they make money. 1 or 2 pips are important to them. So the more you trade, the more they make money on the spread. They don't make you lose your trade. They make money on the spread, the cost of transaction. It is not in their interest to tell you to let your trades run longer than the same day. They don't care. They won't tell you. Okay. If you want to give yourself best chance to succeed, first learn to trade profitably without leverage. Learn to trade. First, learn to trade profitably without leverage, and that will mean that you capitalize your account sufficiently. You fund your account very, very well. So play it safe, protect your account. When you can consistently make more pips, more than you lose, then and only then should you use or unleash this weapon of mass destruction called leverage. Destroy traders taking the opposite side of your trade, and don't destroy yourself. So forex trading should be treated as a job or a business. Don't think that just because brokers allow you to use high leverage with a low minimum deposit that you can make quick or get rich quick. That approach of the currency market, people who approach the currency market with that treat the market without respect. Be realistic in your expectations and be willing to properly educate yourself. If you don't, you will die. Okay, not really, but your account will die. So here is how we come to the end of 10.2. Okay, understanding leverage. So far, I enjoy this topic, and I hope you do also. So if you like what we have been talking about, discussing risk management, if you like it, smash the like button, subscribe if you haven't. Until next time, I'll see you in the next lesson 10.3.